What is up, YouTube? This is the Working Investor. Today I'm going to show you in this video how I strategize using hedging by using the inverse funds. I'm able to find multiple ways to get extra money through my high yield dividend ETFs from YieldMax and Roundhill. For example, all these numbers you see here is money that I actually ripped off the top selling into pumps. I used a multitude of strategies together to get multiple ways to make money. So you can see here like QDTE, so basically I have like an allocation how much I invest per fund. And once the fund is above that allocation, instead of watching your numbers go up and down, like core number compounding, I just sell into them and put the money aside. And sometimes I'm able to rebalance, sometimes not. But this is money in excess after rebalancing, and I'll explain to you in a minute what I'm talking about when I mean rebalancing. So here you have QDTE yesterday $30, XETE $30, Facebook 30, XETE 20, QDTE 20, 5.2, Coney 63, NVIDIA almost $40. And you can see here again, my high yield dividend ETFs during the beginning of the month started with a portfolio of like about half this size. I guess I stepped into it pretty quickly over the month. I probably have to take a break. I don't know. It's very addictive. It could be very dangerous. So you can see here that from my smaller portfolio, I received $1,316 in dividend. That obviously for the forward dividend will probably be about double that, as based on projections, because my portfolio pretty much doubled. But you could see here that a significant amount of money that I have relative to my dividends, almost like 50%, is coming from ripping, selling into pumps. So let me show you some of my strategies that I use that I play around with my inverse fund. So my objective is to find funds that I know people say that you don't have to worry about the net asset value. You can kind of make a blind eye for it. But for me, I feel like the NAV does matter because you can have it can provide opportunity to have multiple ways to make money. Also, if your NAV, if your net asset value is preserved, it helps you. You don't get into as much trouble if you're using margin, because if your net asset value drops, you can get in trouble. And also you can get out if you need cash, you could just get out of your position and liquidate to 1, 2, 3, and you're pretty much made whole. So it kind of gives you a lot of like an escape plan. It gives you the exit plan if you have net asset value preserved. So I try to find underlyings that relative from history have preserved their net asset value. Like I've noticed AMZI and Phoebe, but which is the underlying of Amazon and Facebook respectively, or Meta. But again, past performance is not indicative of future gains. Anyway, so let me go here to my strategies. Then I use these very volatile ETFs that provide a very, very hefty dividend because they're super volatile. But I hedge them with inverse funds. So I'm a very big proponent of inverse funds. I've been testing them out, and I've pretty much have purchased every single inverse fund, and I've been playing it with every single one in YieldMax with their ETFs. So let's say NVIDIA and DIPS are both under the same underlying of NVIDIA. NVIDIA is a synthetic covered call, DIPS is a synthetic covered put. My allocation I put to this entity of NVIDIA and DIPS together collectively is $10,000, of which this wasn't a 50-50 split. This has been a 65% to 35% split. So my allocation you can see here in NVIDIA is $6,500, but it says $6,610 because I'm up about $110. And in DIPS, my allocation is $3,500. So you can see here I'm down about $48 because it says $34.52. So now if you notice, when the market opens up, I may rip off the top. I may rip off the excess of NVIDIA, which I'm up $110. I may take that money, a profit, put it to the side, sell a few shares, and then of the proceeds, maybe buy $48 worth of shares of DIPS. So what I'm doing is I'm effectively lowering my cost basis of DIPS by doing that. And you know what they say, you want to buy low, sell high. So So basically, NVIDIA is going up, so I'm selling high, and I'm effectively, and the inverse has gone down, so I'm buying low. So I'm effectively constantly lowering and lowering and lowering and lowering my cost basis. So when sometimes these funds, they lose net asset value, when lowering your cost basis, you kind of protect yourself that way. And I'm sure you guys noticed there's a discrepancy because NVIDIA, if I sell the $110 excess off the top, cut the cream off the top, and I apply the $48 in dips, if you notice, there's a discrepancy of $60. So that's what I'm talking about. That extra $60, what do I do with that? So I typically put that to the side. Number one, you can keep it to the side, and that can lower your margin. If you're using loan, if you're using margin, now you could just keep it in your to reduce your margin, your interest, or you can keep it to the side and use it for if sometimes there, just like there could be a discrepancy, and I'm going to show you my other examples where you have a surplus of money after you've rebalanced. There can also be a discrepancy where you have a deficit. So you can apply it in the future if you have a deficit in the discrepancy. You could see here, and again, all these numbers are actually a little bit off because it's pre-market. And you've noticed sometimes NVIDIA will represent what's happening with NVIDIA pre-market or post-market, if depending where you are, how you want to look at it. And dips may not be representing it correctly. So there could be actually a stronger move to the downside, which you don't see. So really, I'm telling you, it's best to see when the market opens up. Sometimes these things look a little bit, incorrect. You have to wait till the market opens to have the true value. And you can see, let's say, for example, Tesla and Crash, where here I have it in, they're both the underlyings of Tesla. I have $15,000 in this position, split 50-50 split between Tesla and Crash, 7,500 in Tesla and 7,500 in Crash. But you could see Tesla is up over $100 and Crash I'm down a little, like $106, and Tesla I'm up 102. So it's just like a $4 discrepancy. I wouldn't really do anything. I just let it. I'm actually slightly in the negative, but again, it's pre-market. So again, the reason why I like to do this is, number one, again, it helps you with small fluctuations, because when you pit a synthetic covered call ETF versus a synthetic covered put ETF on the same underlier, basically inverse funds of each other, it helps with small fluctuations, your day-to-day fluctuations in the market. But even the prospectus tells you straight up that it's not really, you can't really use it as a good hedge, because it's not going to be a perfect hedge. Because if if there's a black swan event where the market really takes a tumble and it goes beyond your puts, your strikes, you could potentially have both funds down, and you could get in a lot of trouble. So it doesn't really protect you 100% from like a black swan event at all, to say the least. But if you don't mind playing around with this fluctuations, and it kind of keeps it kind of sort of on the day to day keeps your net asset value roughly about equal. And you could play these games with like cutting off the top when you have the extra, lowering your cost basis. I love these type of little strategies. I also kind of frankly find it boring if you have only one way to win. I mean, I guess you could say that if you win the lottery and you win money, then all this option stuff would also be boring. But I like to have fun and play around. So here you can see I have my Coney Fiat. This is basically, looking at the Bitcoin world, because Coney and Fiat are both underliers of Coinbase, and Coinbase correlates somewhat with the price of Bitcoin. So you could see here again, like, there's 7,500 in each of these positions, $15,000 collectively as a entity, how I look at it. And you can see that I'm up like $86 in one fund, but I'm down about $100 in the other. So you can see there's a discrepancy with a deficit. So just like you can have a discrepancy with an excess, you can also have discrepancies of a deficit. So you have these different ways of doing it. And then here, these are 0 day to expiration, XDT, QDT, but that's not really related to what I'm talking about in the video. But both of these have a $5,000 allocation. If you notice, I actually bumped these up because they used to be a $2,500 allocation each, but now I just bumped them up. But I was able to rip off the top because they had a good day, because I'm not just going to watch the account go up and down and not do anything about it. I like to do stuff as it happens. But as you could see that my portfolio is close to being whole. Facebook, Phoebe, I had a $2,000 investment initially. I already ripped $30 off the top, and I still have now $20 still above my allocation. AMZ is the only one that's still down. My initial investment in AMZ was $18,000, and I've received the dividends, which has been reinvested into itself. And I'm only about, just a little under $200 from my being whole again. Once I'm whole, then I try to see if I could spill the excess into a new allocation, a new fund. So that's what I'm doing right now. I'm literally, like I said, I'm literally playing around with every single inverse fund over here. I hope you guys find this valuable, and I hope you guys have a wonderful day. This is the Working Investor, over and out.